This is Equity Investor with Julia Lee.
Welcome to the program. I'm Julia Lee from Bell Direct, and on tonight's show, Retail Food Group shares. After the company's core business model comes into question, the shares go into free fall. Plus, our experts will put QBE shares to the test. And in our stock in a minute, a company that may have a latte upside. We'll talk Starbucks. And my guests tonight, here with me in the studio, Kim Slater from County Securities and Michael Gable from Fairmont Securities, and a bonus from our Sydney CBD studio, Elio D'Amato from Lincoln Indicators. Don't forget you can reach us at eq@skynews.com.au or hashtag Equity Investor if you are on Twitter. And if you want your question live on air, please include a contact number and we will ring you back. But first, let's have a look at some of the trending topics. And look, the market is all about the trade wars at the moment. Are we going to see the tariffs in the US leading to a trade war and a possible global recession? Is the franchise model dead? We're seeing Caltex as well as Retail Food Group coming under pressure, and it's also dividend paying season. What does that mean for your stock portfolio? I guess just lastly, looking at the dividend paying season, and we've come to know the Santa rally, which is in December, and part of that is a large amount of dividends that's paid in that month. Do you expect this dividend paying season to be supportive of shares, and will particular sectors benefit given we are seeing a lot more dividends coming out of the resource type stocks, Kim?
Julia, that's an interesting question. You always tend to see a bit of a rally in the market in March and April as those dividends do start to flow. So I don't think this year is going to be any different. Historically, it's always been the banks that have participated in that rally. So I think you'll probably see the same thing. Look, it's an interesting question where people actually put their dividends, and the one thing that they're always chasing, of course, is safety of capital, and of course reinvesting the dividend to get another dividend. So historically, you're always going to see, I think, a flow back into the safe bets, and the banking sector being 42% of the market.
I mean, Michael, would you agree, given that what we're seeing in the bond market and that dividend-paying companies or high-yielding companies may underperform the market this year because of those higher bond yields? What are you saying to clients in spending these dividends, I guess?
I do think our market will be well supported here. We're coming off a bit of a low base given that sell-off in February, and the strength of the rally in our market a couple of weeks ago lends me to believe that those recent lows just under 5,800 should hold for the moment, despite the sell-off in the last few days. So, I'd be putting that money to use. You make a good point about the bond proxy style stocks. I wouldn't be looking to reinvest in those, but as Kim said, I think banks are looking good here, and the resource stocks as well, I think, are further upside.
It's time to bring in Elio, and let's bring him in on our first email. This says, hi, can you please let me know your thoughts on Retail Food Group? What price do you value them currently? And this one is from Hilary Scotchman. And I guess looking at Retail Food Group, the big question becomes, is it the franchise model that's dead with the high wages that we have here in Australia, rising rents as well as rising interest rates globally? And Elio, we might throw it to you. What are your thoughts on Retail Food Group? Is there a price where this starts to look like it's good value, or is this your typical value type trap?
Yeah, Julia, I mean, when you've got forced asset sales across the board in order to meet your debt covenants, it's never a good sign, and unfortunately there seems to be a hell of a lot more pain. We know Retail Food Group used to be one of the stocks we covered last year. We removed it in July at around $4.58 on the back of the Alford family ceasing their association with the business, plus the emergence of these real strong active risks, and we've seen it play out, unfortunately, in the scenario that we have. There is a big turnaround strategy. They need to revitalise the brands. Unfortunately, debt rose on the back of getting their stores up to scratch, and unfortunately the write-downs are just a kick in the teeth that it really didn't need. So unfortunately, no, there is no real price. I've seen broker downgrades cut to below $1, so one would suggest that it's even overpriced at this level. I think there's I think there's far more operational issues at play that we're yet to really uncover, and I'd very much say it's buyer beware. If you're playing this game, it's only short-term bips, not
I mean, the share's finished.
Try zero.
Oh, wow. We've got Kim saying zero. You think that it's a death spiral here?
The model, as Michael and I were talking before the program, it's fundamentally flawed. I mean, you can't keep loading all of these costs onto the franchisees, and RFG taking its take of that, and expect those businesses to survive. It just doesn't work. And you know, they've been successful up to a point, but the problems have got bigger than the group. And quite honestly, I don't think there's any. There's a put it this way, a very limited future for RFG, unless they destructure the business and do something radical with the franchise arrangements. It isn't going to survive.
I mean, Michael, this is a huge call by Kim saying, you know, the value could be zero for Retail Food Group. And it brings into question that franchise model here in Australia. We've seen a number of franchising models now coming under pressure, where Caltex is looking to buy back its franchisees by the end of FY19. Domino's, an international franchise, coming under some pressure, and even McGrath, which has a part franchise model, coming under pressure. What is it about the franchise model that's run into trouble at this point in time?
Yeah, there's clearly a trend there. So I think, you know, buying Retail Food Group, you're betting against what all these other companies are trying to do with that particular model. So in the case of Retail Food Group, you know, the costs are huge for each individual franchisee. So for Retail Food Group to survive, they're going to have to do some sort of deal with each individual franchisee to support them. That's going to affect their earnings, and it is a bit of a spiral. So I think valuing the company at close to zero is not a, you know, a huge call. I mean, it's
a massive call.
You've got net debt of about 260 million, and
Yeah.
someone pointed out that the market cap's now about 230 million. So it's in trouble.
Okay, some big calls coming through from our panel tonight.
That's why we're here, Julia.
That is why you're here, Retail Food Group. So not touching it at this stage. Let's go to a tweet now that we've received from Shane Davis. And let's have a look at this tweet on QBE Insurance. And having a look at the wall, it should be up in a second. I believe that his tweet may be on QBE Insurance. Is this looking like a value trap, or is it time to buy when the stock dips under that $10 mark? And I guess QBE Insurance, it is one of those stocks you'd think would be doing well in a rising interest rate environment, but really it's just been struggling with itself. It's the business versus rising interest rates. Rising interest rates obviously positive, but the business environment that QBE is operating under, obviously a bit of a struggle for it at the moment. But a new CEO on board this year. What do you think of QBE, Michael? Would you be buying it?
I wouldn't be buying it. I mean, for a number of years I've avoided QBE. It is a very complex business. I think the market was a little bit, maybe took a positive view in that new CEO is doing the tough sort of write-downs. Maybe that's a turnaround point, but I don't think that it's simple enough to trade that range of about $10 up towards 14. At some point that range is going to break. I believe it'll be to the downside. So eventually I'd be a buyer as a trade when I see everyone else finally give up on it. So all these analysts who have been, you know, putting buy recommendations on it and supporting it for so long, when they finally give up and this stock drops to about $8, then there's a potential trade. Talking
about some of those analyst recommendations, let's bring up some of those analyst recommendations on QBE Insurance and the buy, hold, sells that we have in this space. This is a chart of QBE Insurance. It's not looking so good. What do you think we're going to see here? Are we going to see buys, holds, or sells? Well, we've got 6 buys here, 6 holds, and only 2 sells.
Is actually 6 sells. We know what a hold is.
Industry jargon.
Yeah.
And would you be selling it, Kim?
I wouldn't be in the stock at all at these prices, Julia. I mean, QBE's always made its money out of the free cash flow that it's had, and it's always had, you know, that's always been a big part of its earnings component. But the reinsurance business is so tough at the moment, and with the new CEO, there's more than likely to be other write-downs that are coming through the business. So I'd have to agree with Michael. He said $8 a share. I'm probably a bit more bearish. You know, somewhere around $7.50 would be my entry point.
Elio, what do you think of these big calls coming through here? QBE Insurance. There's a new CEO. We've heard this story time and time again before, where, you know, a new CEO comes, it clears the decks, a few write-downs, downplays the business prospects, and then hopefully turns around the business. And I feel like this is a battle of Patrick Regan versus global interest rates. What's going to win out?
Yeah, it's interesting, isn't it? I think that operations versus the interest rate argument's a fair one, and we tend to think that operations is winning out, unfortunately, to the negative side. We removed it within our coverage 6 months ago as we were really concerned about free cash flow conversion relative to where margins were sitting. The Latin American business we now know is gone. Lax underwriting processes have also been a challenge. So there are a few issues that the company needs to embark on, including possibly some further asset sales to really focus on some of their more profitable businesses. So we're going to leave a few cents on the table for the next guy. I'll share the pessimism with the panel. Although that said, I don't think dire is the situation here. I just think a little bit of pain and sideways movement is probably more what you're going to experience.
Three strong analysts, and we've got agreement on QBE Insurance. It looks like a sell here from
to do with price.
a whole panel to do with price. If it gets down to $8 or $7.50, it looks like we may turn into buyers for QBE. Let's go to another tweet that we've received here, and if we can see this tweet in the wall. I think this tweet is about Jat Energy. I guess this is a company, it's a smaller company, and I guess looking at the share price, it's done extremely well. And look, this is a company that's a little bit unusual at the moment, moving from coal into infant baby formula. And, when you start to see companies jumping on the trend at the moment, you start to get a little bit cautious. We've seen this with the tech boom. I think Jat Energy at one stage was involved in renewables, and LED lights was a theme for it in 2015. At the moment, it's trying to negotiate with a Chinese company to push its Golden Koala milk brand. A buy or a sell here, worth a bit of a punt? Kim, what do you think?
Oh, I'd like to see the volume chart with that price chart, but if it's up 900 odd %, it's a tough one.
It's a tough one. 6 months ago it was 1 cent. I would guess that was while it was a coal company, but now it's moving into infant formula. What do you think, Michael?
What I jump in and say is that first of all, you'd want to see who the company was running or being run by, how much cash it's got on the balance sheet, who's making its formula. It's probably obviously not buying it, but it's obviously buying its formula from a third party. So it beggars some more research. We've seen companies like that, Wattle, which is...
Wattle Australia, Bubs, A2 Milk, Bellamy's, Jat Energy. It's starting to look a bit crowded.
If they actually do get onto the tail of it, it could be worth following.
And what do you think, Michael?
I had basically a less than a 5-minute look at this company, and I could not see anything positive, I have to admit. So it was about a cent or a couple of cents a few months ago, came back online, rallied to about 20-something cents. They've done a capital raising. The directors have stuffed something up and have had to sell shares on market. And when I had a look at the chart, it just smelt of excitement getting sold into. So someone was selling into this excitement, just looking at the volume. And as I said, I've only had a 5-minute look, and I'm sure others of the stock will hate me, but it doesn't look very...
There doesn't seem to be a lot of love in terms of the stocks we've been looking at today. So let's try for another one. This one's an email from Scott, and Scott says, "Hi Julia, looking to invest in Platinum Investments Group. Looking for an opinion buying the company, share, its ETF or managed fund, which all appear to have declined since the announcement of Kerr Nielsen's departure. What do you think about Platinum Asset Management? It is the #1 international equity products company to retail Australian investors. And I guess this is a question of Kerr Nielsen versus the brand Platinum. And can the brand Platinum survive without major damage now that Kerr's looking to leave?" Elio, we might throw to you on this one. What's your view on Platinum? Is it a bargain given the pullback that we've seen? Would you be happy to invest in this company, or too much of key man risk and too much of a risk that we'll see some fund outflows on the basis of Kerr Nielsen leaving?
Yeah, I don't think you'll necessarily see that as much, Julia. The succession plan's pretty well earmarked, and everyone should be, if they're already in it, feel very comfortable with that. Interestingly, Platinum over the last 5 years has pretty much just tracked along side the market as opposed to our preferred in the space, which is Magellan, which has done a lot better. And from our perspective, we think there's more growth avenues, particularly with their North American distribution acquisition and their early acquisition here in Australia, giving them domestic funds management space. But Platinum, look, obviously Kerr's still going to be around in some shape or form. It does highlight the risk of, you know, one key man running the show, but sometimes Kingmaker can also go pear-shaped too, and we've got plenty cases of that. So I wouldn't be so worried about that. More, I'd be focusing on the company's long-term growth strategy and where they see themselves being in a few years' time relative to where they are today. And we know all fund managers, including BT and the like, have had a very good period, but in terms of growth opportunity and consistency of income, Magellan's our pick out of those three that I've talked about.
So some really great points coming through from Elio about, you know, fund managers usually doing well in an environment where the share market is rising, as we have been seeing. However, there are other things to look at, and I guess that's things like fund inflows, which is related to performance and performance fees and fees in general. In terms of Platinum, would you be happy to buy here, especially given that I think around about 80% of funds under management is in one fund? So you're still seeing key person risk even with Kerr Neilson leaving. What do you think, Michael?
Look, I agree with everything Elio said. We had a couple of clients in Platinum, and when the news came out, actually just sold first, asked questions later. So I think long term the company could do well, and obviously they've had all this succession planning in place for a while, but at the end of the day it's all about the inflows, and these type of businesses are so leveraged to the funds under management. So any sort of hiccup, even just in the short term, could start to affect the bottom line. So I think the shares will get cheaper first. So
would you be buying?
Not yet. I'll wait for them to get cheaper.
Okay, we need to go to a break, but when we come back, the guys give us their stock picks, plus a look at an American coffee giant and how you can get exposure to that market.
You're watching Equity Investor on.
Now for our stock in a minute. It's a coffee company that's becoming less about the Java and more about being a local gathering place. Here's Vihari Ross, who's the head of the franchises and portfolio manager at Magellan.
Well, people in Australia really don't tend to think that much about Starbucks, but it is truly a global business with incredible competitive advantages. And one of the things that makes it a quality business, beyond its scale and beyond its locational advantages, is the fact that it is a third place in the consumer's mind. And what that means is that it is a place of refuge. It's a place to hang out with your friends or alone, a place where you will get consistently good coffee with a barista that knows your coffee order, and you'll get it in a very convenient location. The next thing that we like about Starbucks is that it is a growth business. They have an enormous growth opportunity available to them in China. In the US, their home market, they have one store per 20,000 people. In China, just looking at the middle class population, they have one store per 100,000 people. So even with no growth in wealth in that market, even with no urbanisation, they have an opportunity to roll out stores at 20% per annum for the foreseeable future. And what that translates to is earnings per share growth at a minimum of 12% per annum. And we are paying a very reasonable price for that. And that is the reason it is an important part of the defensive component of Magellan's portfolios.
I know a lot of Australian investors do tend to have a huge home bias, and I guess Starbucks is one of those companies that's traded over in the NASDAQ, but of course exposed to this booming China story. So I guess having a look at how Australians can access investments like this, what do you think of Starbucks, or accessing those investments that do give you exposure to that growing middle class in China? Michael, what do you think?
Yeah, I mean, it is a great way. I mean, firstly, you need to find a broker that does international shares, and I have to say we now do international shares.
Oh, very good.
But just thought I'd slip that in. But apart from that, look, I mean, in terms of Australian stocks, obviously we've got the miners, we've got your A2 Milks and so on. But otherwise, you need to look for ETFs. But we were talking about Platinum before, and they're quite heavy and bullish on China. So there are other unlisted alternatives.
There's only one thing I disagree with that synopsis on Starbucks is that they're consistently good coffee. I defy anyone that's drunk their coffee to say that their coffee is good. So if they're talking about this rollout in China of one store every 20,000 people, it's going to be interesting to see how they adopt the product, because at the end of the day, you've got to sell the product or the consumer's got to want to buy the product. And I think that's one of the things that could be a stumbling block for them, is the acceptance of that product in China. So I just wouldn't say that, it's going to be, China's going to welcome Starbucks with open arms. I still think that it has to be proven.
So good point by Kim. I mean, Elio, we saw some of those amazing growth figures that even, without a full-on expansion plan that's looking at 20% growth because of China. What do you think of something like Starbucks? Is there anything similar over here, or do you go and access international investments to gain access to the type of growth that Vihari has been talking about?
Well, I've got to admit, Julia, I did chuckle when it was Starbucks that came up there, because, of course, we've just spoken about a company that has a heavy coffee presence with franchises and unfortunately hasn't done all that well. So, look, the only thing I'd add to all the discussion is don't underestimate the power of brand, particularly when advertising and selling into China. That will be obviously a big kicker for Starbucks. I mean, they're trading at quite high levels now relative to where they've been, so the call's been right, up to date. In regards to the future, though, well, it'll all be about execution and obviously being able to deliver on that. But yeah, domestically, I think we're going to leave that one. I think Starbucks would be your best bet if you really wanted a coffee-based franchise.
Okay, it comes to my favourite part of the show, and that's getting the buy recommendations from some of our panellists. So, Kim, we might kick off with you today. What have you been buying on the market?
Well, I threw this one up against the wall a couple of weeks ago, Julia, and I'm sticking with it, and that is with the miners with Rio and BHP. And we've seen with the half-year results that they've both had produced very good results, high cash flow, increased dividends. And I think there's more of that to come. So I'm looking at any pullback in the miners as an opportunity to buy.
Synchronised global growth in BHP and Rio Tinto can't go wrong in 2018.
It's a lovely symphony.
It's beautiful. Michael, how about you?
Oh, firstly, I agree with Kim. I mean, I'm looking to buy both of them as well. BHP closer to $28, so we're almost there. But my buy recommendation is St Barbara. Basically, St Barbara or Northern Star, gold stocks. I think gold's looking interesting. St Barbara and Northern Star both consolidated at the beginning of this year in terms of their share price and have recently broken higher. And in my opinion, it looks like they're going to keep running. So happy to add those to the portfolio.
Okay, so BHP, Rio Tinto, St Barbara Mines. Elio, are you going to come up with some resource companies, or are you going to go for something different here?
Yeah, well, we like gold stocks too, so good on you, Michael. But ours is WiseTech. It just threw up a bit of an opportunity this reporting season. It's been caught up in that whole sort of get swift/high PE phenomenon. But look, we had very strong earnings per share growth of over 40%, expected to continue over the coming year. And furthermore, Richard White continues to hold a significant interest in the business, showing that his interests are aligned with that as shareholders. So a great star growth stock, and we remain very comfortable with WiseTech, and we feel this price decline is just a great opportunity to acquire more of this great Australian story.
Lots of fantastic ideas from our panel, and we hope you've enjoyed the program tonight. A big thanks to my guests, Kim Slater from County Securities, Michael Gable from Fairmont Equities, and also Elio D'Amato from Lincoln Indicators. And a reminder, you can watch the show anytime with Catch Up on Foxtel Go and On Demand on Foxtel IQ. We also have a podcast which you can find at skynews.com.au, and if you're overseas, we're available on demand on australiachannel.com.au. I'm Julia Lee from Bell Direct. Thanks for your company.
Information presented on this program is general in nature. Viewers should seek their own professional advice before purchasing products or services. The producers of this program